My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach. So call me at 1-800-743-CBC or tweet me at Jim Cramer. Here we go again with the value over growth trade, which is how you get a day where the Dow jumps 423 points, S&P gains 1.23%, while the Nasdaq just inches up 0.42% after spending a lot of time being way down in what was a very ugly swoon.
The house of pain.
Look, I get it. The high-flying tech stocks have had a huge run. Value has lagged. So as we pick through the rubble from last week, investors are dumping growth stocks and swapping into value names. At some points today, well, it was pretty much breathtaking fashion. As someone who's watched these rotations come and go over decades of observation, let me explain how they work to help you get your head around the collapse of tech that's been in the making for a week and the ascendance of some of the most pedestrian companies around. First, early this morning, well before we even got near the opening bell, probably around like 4 o'clock, 4:15, every stock seemed to be indicated higher. It looked like the start of a big, broad-based move that could reverse a huge chunk of last week's sell-off. And by the way, between 5 and 6, it was being led by tech. The strength felt widespread, perhaps a follow-through from the late-day rebound on Friday. There's just one problem. Investors legitimately have no idea what's coming in the next 48 or even 72 hours, or however long it takes to count the votes. And they're susceptible to any suggestion that might transcend the election. In other words, everyone's sick of the election. They want to make some money in spite of it, not because of it. Honestly, I don't think anything will be able to withstand the withering fire of the actual election results. At least not in the short term. But traders are determined to make money every day. They refuse to be deterred by the ballot box or the virus, for that matter. Into that vortex, voila, comes a War and Peace-sized tome from JPMorgan Research. You always love that when someone sends it to you and says, listen, be careful. It's 167 pages. Be careful, because no one wants to print that out. A lot of trees. What does it say? Well, I'm going to give you the gist of it. It says, time to abandon growth. Switch back to value. I think it would have been more valuable before tech's come up its last week. Usually this kind of note has enough staying power to influence a couple of portfolio managers in the morning, convincing them to dump tech and maybe swap into, say, Caterpillar or Chevron. Well, that's exactly what happened. See, I looked at the piece, and I'll admit it makes some sense. I mean, even after last week's slacking, most tech stocks have had huge runs, and their valuations are stretched. I love Amazon, but I can't seriously argue that it's a cheap stock. Hey, we had Rowan Trollope, the CEO of Five9, on the show Friday. He had just delivered one of the best quarters of the year, picture perfect, and his stock was up more than 130% for the year, so that was vulnerable. Zoom Video's had a great run, but at the highs is trading at 50 times sales, not earnings, sales. Even Apple, which has long sold at a major discount to the big tech peers, finally climbed high enough to join the over 30 times earnings club. These red-hot tech stocks were all ripe for the trimming. They were practically begging for some profit-taking. Same goes for the rest of FANG, Facebook, Netflix, Alphabet. They were ready, although Alphabet did play such a good quarter. They all suffered hideous, well, no, I shouldn't say all, that's too broad-based. Most of them suffered hideous liquidations. But in a rotation, that money doesn't just disappear from the market, right? It doesn't go into cash. Oh, it just goes right into another group. So where did all the tech money go? First, it plowed into oil. All the oils, as the price of crude rebounded at very low levels. The best representative, well, Chevron. It was up 4%. Chevron, did you see the quarter on Friday? It was so ugly, I didn't want to waste my time on it. But I had to. It poured into the industrials. 3M rallied nearly 2%. That I said that Mike Rome doing a good job there, but no one liked it last week. Caterpillar vaulted 4%. They missed their quarter. They missed it. Honeywell initially fell 4 points on Friday after reporting before stabilizing, giving a little rally. Today it caught fire. It was up 5%. I mean, where were the buyers at 162? Even the banks got their group back going. Today, JPMorgan was as cheap as I've seen it in ages. Today, finally, it gained 2%. I mean, for this stock to gain 2% is, well, I don't know. I mean, they have to have found gold in the vault. This move was as easy as a rotation in volleyball. Suddenly, the value stocks find themselves at the net, hammering it down the throats of the other team, spiking it. The tech all-stars like Shopify and Cramer fave Okta just got crushed. Only a handful of the red hots were able to hang in there, like Snowflake, the most expensive stock in the market. And, of course, the sainted Tesla. What was JPMorgan's thesis when they told Wall Street to dump growth and go all in value? Well, they're betting we'll get some encouraging economic numbers, which makes these beaten down cyclicals like, whoa, there we go, more attractive, especially versus tech. They figured we'll see a turn coming in January. Well, as it happens, we got a stronger than expected PMI number today, this very morning, which then sent the rotation into overdrive. People said, JPMorgan's onto something. However, as we got closer to the end of the day, tech got its mojo back. Sorry to use such a technical term. And the NASDAQ was able to mount a half-decent comeback. It felt like the JPMorgan report was already fading away. It was like in the rearview window, yeah? So tech tried its best to play catch-up. Be a new piece tomorrow, no doubt. Now, before I get into specifics, I've got to tell you, I hate these growth versus value calls. Why? Well, first, they're usually made by very smart people who know they can make a splash, and this equity strategy piece did just that. It was filled with really cool-looking charts and graphs, authoritative-sounding commentary, made you want to take action. But what if the recommended action is wrong? What if the growth stocks aren't done going higher? What if value isn't really a coherent category? What if the tech's horrifying decline last week and then ugliness today before a hard pirouette actually defined a bottom, not a top, right in the face of the JPMorgan War and Peace novel? Second, rotations make you suspend any work you've done on individual stocks. Forget the Chevron and Exxon, which screamed higher today, just reported horrendous quarters. Pay no attention to the fact that crude's still down dramatically over the past couple of weeks. Don't worry about Exxon's possibly unsustainable 10% yield. Hard to find anything with more value than oil, right? Wrong. The oil business is terrible. But in rotation, nobody wants to let the facts get in the way of the story, right? Third, hello, there's an election tomorrow. Once we have certainty on the outcome, the tech stocks will be a coiled spring and the value stocks will be spent. How do I know this? Because I run a charitable trust, which owns a bunch of value stocks. I feared that their subpar earnings would keep them from running. Thanks to JPMorgan, they actually got some wind in their sails. What an opportunity to hit the eject button after a couple days rally. Thank you, JPMorgan. However, once we find out who the next president is, we're going to be still faced, with a COVID-led slowdown. Have you noticed that? There are over 100,000 new cases on Friday, new record. The pandemic is, frankly, out of control, which is bad news for America, whether you like or hate the president. Good for the stocks that help promote digitization and make it easier for us to work from home. That's been accelerated, remember? Finally, regardless of who wins tomorrow, we're getting another stimulus package, maybe later this month, maybe in January. But whatever that comes, it will be too late to offset the economic damage from this new wave of COVID cases. Sadly, that's when growth thrives. Right here. I love this. Too late. I was going to put it over here. Almost needed technical help. No one's allowed to touch me. We have a real Hobson's choice going here. If President Trump wins, his laissez-faire approach will have its own set of consequences. Sooner or later, the hospitals will get overwhelmed. In some places, they're already running out of control. They're running out of beds. And even without a lockdown, people will be afraid to leave their homes. Or Biden wins and we get into a partial lockdown where people are also afraid to leave their homes. Under both scenarios, value fails, growth wins. That said, this kind of rotation call is a godsend if you own the oil stocks. You're finally getting a chance to sell them into some strength, which is I am pleading you to do. Here's the bottom line. Whenever you see someone preaching about growth versus value, you got to remember that there's growth, there's value, and there's a little-known third category. It's called no value. The beaten down stocks that deserve to go even lower. The no value names are like roach motels. Buyers check in, but they can't check out. Unless a firm like JPMorgan steps in with a, kind of a too bullish piece about value versus growth. And that gives you a chance to escape.
Don't miss a second of Mad Money. Follow @Jim on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.